Today, the property signs for the 18th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. In today's post, we look at the dynamics of the Sydney property market, why the RBA thinks we need less migration, APRA's wet lettuce approach to credit regulation, and the words of Michael Burry of the great short fame that we are in the greatest speculative bubble of all time in all things. First, according to Domain, Sydney's runaway property price growth looks set to lose steam over the cooler winter months as affordability constraints and an increase in the number of homes for sale take some of the heat out of the city's property market. The strong buyer competition that saw Sydney's property prices soar to new heights is easing, according to industry experts, with a lift in listings giving buyers some more time and choice at the same time as a growing number of house hunters have hit their affordability ceiling and some fatigued buyers have called off their search. There's less frenzy, said Ray White, New South Wales chief auctioneer Alex Patero, because there is more stock on the market that has taken a bit of air and heat out of it. The increased number of homes for sale has given buyers more choice and breathing space, easing the fears of missing out and enabling them to be more discerning with their buying decisions, he said. Buyers were more wary of overpaying and less willing or able to stretch their finances to secure a property, particularly for those homes that did not tick all the boxes. Those properties with less desirable features or locations are now more likely to be passed in, whereas 8 weeks ago it didn't matter where it was, what road it was on, it would still sell, he said. But he added, quality homes are still achieving ridiculous prices. Recent weeks have seen Sydney's auction clearance drop to the low 70s for the first time since last year, according to Domain data. About 1 in 7 properties, or 14.4%, scheduled for auction over the past 4 weeks failed to sell under the hammer or post-auction, reported results show, with about another 17% of auctions withdrawn or postponed. Buyer turnout at auctions has also fallen but is still strong, he said, with properties now drawing an average of 6 registered bidders, down from the 8 to 10 2 months ago, though the number of active bidders has seen little change. The number of buyers through open homes has also eased over the past month, down about 11% from the previous 4 weeks, according to Domain figures. Auctioneer Michael Garofalo of Cooley Auctions said a market slowdown was typical of winter, but added the clearance rates and rapid price growth seen earlier this year had been unsustainable. He felt buyer confidence and numbers remained strong, but their spending power had reached its limits, with some deciding to sit on the sidelines for a while in hopes competition would ease in the coming months. They found a ceiling. They are happy to go to a price achieved earlier this year, but they're not going to pass that, he said. Earlier in the year, if the market was running, they were chasing it. They follow it to a certain point, and then they have to pull up stumps, because now it's getting ridiculous. On the other hand, more vendors were getting carried away with expectations and overshooting price growth, with properties passed in at auction if they did not meet the market, he said. Still, about 3/4 of homes sold under the hammer by the auctioneer last month went for more than the reserve, averaging around $124,000 above expectations, although this is down from the $195,000 in March. I don't think growth is running as hot as it was. I think we've hit the peak and it'll be going sideways for most of the winter. Whether we pick up and run again in the spring has yet to be seen, he said. AMP Capital Chief Economist Shane Oliver says the rate of price growth had likely peaked. However, values will still rise, albeit at a slow rate, because lower interest rates and government incentives were still pushing up prices. The economy is also continuing to recover, and there is an element of people worrying they'll miss out. But on the flip side to that, prices have risen so rapidly in Sydney, they're up about 14% in the past 4 or 5 months, that it's started to impact affordability, which in the first instance is a dampener for first home buyers, but also for existing homeowners looking to trade up, who are now scared of doing that because it means they'll have to take on a lot more debt than they previously would have. In the eastern suburbs, the unit market is rebounding with a return of investors, and the top end of the market is showing no signs of slowing down, said a principal of Rain and Horn at Double Bay. But the middle of the market was starting to soften, with mediocre properties in particular taking longer to sell. Buyers in that middle market have a bit more choice now than they had a couple of months ago. It's a more normal market, and they're becoming a little bit fussier. We're also getting a few buyers now saying we'll wait for spring in the hopes that there'll be more choice and the ability to get something cheaper. Over in the inner west, a buyer's agent there agreed the heat has pulled back a little. There have also been more buyers deciding to hold off, but noted that good houses were still getting phenomenal money, with many homes selling before auctions as those tired of missing out make strong pre-auction offers. But another cooling effect might come as the prudential regulator has written to ADIs to ensure that they're proactively managing lending risks and focusing on lending standards amid some increased risk-taking, according to the Council of Financial Regulators, as I reported yesterday. The Council of Financial Regulators released its quarterly statement from holding its quarterly meeting on the 11th of June, where they discussed the housing market risks, lending standards, and the regulatory arrangements for property e-conveyancing. It said that overall lending standards in Australia have remained sound, but noted that there had been signs of some increased risk-taking recently. The CFR said that APRA had written to the largest authorised deposit-taking institutions to seek assurances that they are proactively managing risks within their housing loan portfolios and will maintain a strong focus on lending standards and lenders' risk appetites. The RBA recently cautioned lenders and the finance sector against excessive risk-taking amid rising asset prices, including looser lending standards for loans. It warned that in the current environment of accommodative financial conditions and rising asset prices, including rising property prices, it is particularly important that the financial services sector does not engage in excessive risk-taking. Members of the CFR also stressed that they are looking at potential policy options to address the risks that could stem from household borrowing substantially outpacing household income growth. Council members have underscored that they are paying close attention to the implications of trends in housing debt. Analysis by Moody's Investment Services revealed earlier this year that Australia's household debt totalled 121.4% of GDP in the second quarter of 2020, higher than any other AAA-rated commodity exporting sovereign, such as New Zealand, Canada and Norway. And furthermore, Australia's ratio of household debt to disposable income has also remained at significantly high levels at 179.9% as at September 2020, the analysis showed. Now, according to the ABS, National Account Finance and Wealth data for December 2020, the housing debt-to-income ratio decreased from 139.2 to 139 over the quarter, as growth in income at 1.2% exceeded housing debt at 1%. But of course, that is a net story because many people have paid down very large loans. The ABS attributed the growth to government income support packages implemented in response to the coronavirus pandemic, including the JobKeeper package and the coronavirus supplement. And Council of Financial Regulator members also discussed developments in household borrowing and the housing market amid rising house prices. It said that housing credit growth has picked up, with further increases expected over the months ahead. Over the past few years, owner-occupiers have accounted for most of the increase in household borrowing, they said. The demand for credit by investors has been subdued, but it's now increasing. And recent APRA figures show that while owner-occupied lending across ADIs grew across April by 0.6% or $6.9 billion, the rate of growth slowed from 0.7% or $8.3 billion back in March. On the other hand, investment lending increased by $2.1 billion or 0.3% in April, making that an increase from March of 0.2% or $1.6 billion. Amid record low interest rates, government incentives such as home builder schemes and the First Home Loan Deposit Scheme increased buyer demand and reduced property stock. Recent data from the ABS showed that the total value of residential dwellings rose by record numbers in the March 21 quarter, up $449.9 billion and surpassed a total of $8 trillion for the first time to almost $8.3 trillion. In New South Wales, the average price of residential dwellings broke through the $1 million mark. That's the first time that the average dwelling price has surpassed $1 million in any state or territory, rising to $1.01 million. And CoreLogic's daily home value index revealed that home values across the combined capital cities rose by 10.9% over the year to date, 10.2% over the last 12 months, while there was a monthly rise of 1.9% and a weekly rise of 0.5% in values. And research from the Real Estate Institute of Australia found that property prices in capital cities have grown at the fastest rate in a decade, with median prices for houses up 6.8% over the March quarter, while other dwellings rose by 2.7%. And of course, Westpac predicted a 15% rise in housing prices in 2021, followed by a 5% rise in 2022. Elsewhere, Australian unemployment tumbled in May in response to a burst of hiring, further fueling expectations that the Reserve Bank Governor Philip Lowe will not extend the timeline of the bank's yield control measures next month. The unexpected drop in the jobless rate to 5.1% in May, despite a paring back of government employment supports, points to a recovery that is charging ahead of the curve, and also likely strengthens speculation that the Reserve Bank of Australia will raise interest rates earlier than previously thought, amid heightened global expectations of a pullback of crisis stimulus following the Federal Reserve's last policy meeting. The strong labour market data shows the creation of 115,200 new jobs, almost 4 times the expected amount, and it came less than 2 hours before Lowe said the bank saw scenarios in which interest rates would go up in 2024. Lowe said a July the 6th decision on whether to roll over the yield target to the November 24 bond from the current April 2024 depended on the probability of an interest rate rise in the next 3 years. The board will review these scenarios again at its next meeting, he told an Australian Farm Institute conference in Queensland. But his most interesting comment was this: the main effect of the closure of the borders on the labour market is that we can no longer tap the overseas market for areas where workers are in short supply. So what used to happen before the pandemic is if there was a shortage in the labour market of a particular skill, firms would go overseas and tap the global labour market. And that meant if there was a very strong demand for workers in a particular skill, the price, the wage, didn't really move very much because you could go and get workers from overseas. But you can't do that at the moment, or at least it is very hard to bring in workers with skills. It's not necessarily the level of immigration that's the main factor here. It's the ability to tap global labour markets for areas where there is a shortage. And we're starting to hear reports of wages moving for some of those jobs, but other firms are saying, look, we don't want to bid up the cost base now, because perhaps late in the year there will be some way to get workers to come back in with skills that we really need, and that will alleviate some of the pressures. I think if that doesn't happen, and we're still in this position in a year's time where we can't get workers and skills are in short supply, then we will see upward pressure on wages and inflation. So by accident, Lowe has explained that thanks to strong migration, wages growth has gone nowhere in recent years. That's one of the key reasons why no real growth in wages has been seen since around 2011. And of course, if high migration comes back, then that will continue. Still, Lowe warned that there was little sign of the stronger wage growth needed for a lasting increase in inflation, which is needed to raise rates. And it was also too early to pull back on the RBA support for the economy through its bond buying, he said. The bank will continue its purchases beyond the second round of quantitative easing, currently due to expire in September, he added. The RBA's bond purchase programme is one of the factors underpinning the accommodative conditions necessary for economic recovery, the governor said. The key consideration in our decision here is how the RBA can best support the ongoing recovery of the economy. Now, Bloomberg economists say that a surprise surge in Australia's employment in May was probably swung the balance for the central bank's upcoming July policy meeting. Australia has transitioned from recovery to expansion after recouping jobs and output lost during the pandemic, and most economists now also expect the RBA will opt against extending the yield target. And Lowe also needs to factor in Fed officials speeding up their expected pace of policy tightening. The yield on sovereign bonds maturing in November 24 surged by as much as 12 basis points as investors bet that a more hawkish Fed and the stronger jobs data adds to the case for the RBA to decide against rolling forward its yield control. The spread between April and November 2024 notes surged to over 30 basis points. And the Australian dollar was trading at 75.61 US cents in Sydney this morning. Thursday's job data suggests the economy has managed to absorb losses from the end of the government's signature JobKeeper wage subsidy in late March. The May labour force data was stellar across the board, said Sue Lin-Ong, head of Australian Economic and Fixed Income Strategy at Royal Bank of Canada. The data will add to the RBA's confidence in the transition into stronger and durable economic growth, with Governor Lowe borrowing those adjectives from the Bank of Canada in a speech earlier this morning. Both the RBA and Treasury expect employment will keep strengthening based on job advertisements and other forward indicators, that yet there also may be some weaker readings ahead after Melbourne was forced back into a 2-week lockdown to contain a COVID-19 outbreak. Now, if you're buying your home in Sydney's contentious markets, you do not need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying property is both challenging and adversarial, and the vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there is the wasted time and the financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email on info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can receive a 10% discount offer. As America's market picks up, and many begin to predict that interest rates will rise in the near future, so many have called the current growth a bubble based on speculation and little more. Michael Burry, one of the few who predicted the global financial crisis and who was later immortalised in the film The Big Short, is one of those people, tweeting on Tuesday that people always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time, in all things, by 2 orders of magnitude. #FlyingPigs360. Housing is just one part of the bubble, along with cryptocurrencies, but one that has spooked more than a few in the Australian market. After all, when Burry makes predictions, plenty listen. While Australia's property market is outstripping that of the US, they've also seen a huge growth there as well, with the S&P Case-Shiller US National Home Price Index showing an explosion since the pandemic began. And with that in mind, Australian broker spoke to Andrew Wilson, economist at Archistar, to get a read on what Burry has been saying, the current state of US interest rates, and what they might mean for the housing market here in Australia. For me, it smacks of desperation, this talking up of the recent US inflation data, from those who are hoping for more cheap headlines around the prospect of higher interest rates, said Wilson. Now, clearly, we're always going to see higher inflation rates as economies, not just in the US but in Australia, adjust upwards from what was a flat period of price growth as a result of COVID lockdowns. The next 2 quarters in Australia would also see that. We know that inflationary pressure traditionally led to higher interest rates, but we've got a long way to go to reach to the level of inflation that we had historically, which was 10 years ago, the last time interest rates were increased, when inflation was running above the 2 to 3% band that the Reserve says is their target range. The US had an increase in inflation that was slightly higher than was expected. The headline rate was high, but that's because it's coming from a period of low prices. The Fed has said that it's thinking that now, perhaps from a 2024 perspective of higher rates, they might shift to 2023. But they've quite clearly said that there's no solid foundation for that speculation other than higher inflation than was expected. The cash rate or central interest rate in the United States are only half the story. Bonds are also vital. The other point from their meeting was that they're going to continue with their bond purchasing, said Andrew Wilson. They, like Australia and other advanced economies, have been undertaking a significant purchasing of government bonds. They indicated that there was no prospect of them tapering their bond purchases, which is around $120 billion a month. For there to be a chance of official rates rising, we would have to see a long-term easing of bond purchasing, which would be the first signal of a real policy other than airy speculation. The tea leaves were slightly in favour of an interest rate increase ahead of 2024, but it's certainly highly speculative and has no concrete foundation in terms of policy settings. In terms of the never-ending speculation regarding the asset bubble, which includes house prices, he said, I think that it will be finally put to bed over the next 12 to 18 months when we see an easing of house prices, particularly in Australia. With no prospect of an increase in interest rates in real policy settings, markets will ease rather than deflate sharply, as was the speculation from the bubbleites. Well, we'll see. I guess 3 points quickly. The first is, yes, we've got very high levels of debt. That's why prices are so high. Secondly, the amount of stimulation from federal banks around the world is massive, and I'm not sure that they can find a way back. They'll be fighting the markets, of course. Think of what happened last time in the taper tantrums in the US. The Fed tried to deal with it, and then the market said, no, we're not having it, and then the Fed reversed course again. And the third point is this, that ultimately, remember this, that property prices in Australia are 40% over long-term values. And there is always the risk that they will come back to long-term norms. That's what people seem to forget. Long-term norms suggest that prices should be a lot lower than they currently are. And whilst the government can go on throwing money and low interest rates and easy lending standards to try and solve that for a little while, I still think ultimately gravity is going to win. But it will be a long and bumpy road. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.